So in this video, we are going to be going over the concept behind the strategy. You might be thinking, Alex, why would you teach me a concept? Just let's get straight into the entry rules. Let's get into stop loss and take profits, all the juicy stuff. Trust me, this is the way that I teach it. And when you have a deeper understanding of the strategy, you will have a greater chance of success when you trade it by yourself. Understanding something is so much more important than just rushing into it and learning these entry rules. So bear with me while I talk to you about what we have going on here. Are you a bitch? Oh, farting. So first things first, we are going to be looking for consolidation areas, just like this one here. Now, I'm not going to be going over how to find consolidation areas, but I am going over the concept behind it. The next lesson is going to link onto everything here. So the reason why we want to find consolidation when so many people tell you to avoid it are for a few different reasons. One, no one teaches you what to do when consolidation is there. Most people say, hey, avoid it, avoid it, avoid it, avoid it, or they don't even teach you about it. And this gets a lot of traders stuck, so many traders, because no one teaches you what to do when the market stops moving up or down and starts to go horizontally. As you can see from over here, we have areas where the market is clearly moving down, clearly moving up, clearly moving down. But we've also got areas in here where the market really isn't moving at all. And wherever you look in a lot of these areas, if you were to have bought or sold, you could be in a serious amount of trouble. So why would we even consider hopping into an area where we know if we buy and sell, we could be risking our stop losses or even just placing take profits where we're never going to hit it? Well, there's a specific reason why. Smart money, aka the banks, if we talk about who smart money is, right? The banks. We could also talk about hedge funds and stuff like that because they've obviously got millions of dollars. But for this case, we're just going to talk about the banks. That's smart money, right? That's who we're talking about. The banks love these areas and also perpetuate them, which means they like to create them and actually extend their life longer than you would normally think possible in a natural environment where the banks don't exist. Because that's what would be happening. If the banks weren't in here, we wouldn't have market manipulation, for example, and we definitely would not be having fake outs, and we would not be having long areas of consolidation. That's why a lot of us trade smart money, because if we trade the way that the banks are trading, then we're going to be a whole lot safer. So if the banks are involved in these areas and we are smart money traders, then there is an opportunity for us to hop into the markets. Yes, indeed there is. Because what is going to happen here is that the banks want to trade with 1% of their account, right? 1% of their account. Have you ever thought of why we trade with 1% of our account? Why it's just this adopted, I guess, rule across Forex, across futures, across crypto, across stocks, whatever you're looking at. Because Wall Street and the people that worked for the banks, all these guys are interconnected, would trade with 1%. And that has trickled down to us over the years. Or that is what I believe from the best of my knowledge, right? Me being in the market for such a long time. They trade with 1% of their account. But you and me, right, if we're looking at us, retail traders, right? This looks like it's the US. Let me do this instead. Retail traders, right? Instead of us, retail traders, which is you and me, what is 1% of our account? If we bring this over here and we look at it comparatively and we go and say, okay, well, 1% of our account is going to be what? $100? $200? $300? We're probably looking at anywhere between $100 to $1,000, right? Probably, if we're lucky, we might have $1,000, anywhere in between here. What is it for a bank? What is 1% of their account? Is it $1 million? Is it 2 million? Is it 3? Is it 4? Is it infinite? How much money does a bank have, right? It's got all your mortgages, all your life savings, and the life savings and mortgages of your next door neighbor, of that next door neighbor, and that one, and that one, and that one, across counties, across countries, across states, everywhere, right? These banks are incredibly powerful. So what's 1%? As I said, we don't know. So we do know that it's way easier for us to get $100 or $1,000 into the markets, because what brokers do is they basically say, hey, you want to hop in for $100, and so does your friend Nick and your friend Mark and your friend Katie and your friend Alan. All these people, you all want to hop in with $100. Together, you've got $800. Well, we're going to put you with another friendship group that also want to trade with a combined $5,000, and another one here, another one here, until it's big enough that it can enter the market. That's what brokers do. We clump them all together because people are wanting to hop in at very specific times. There are millions and millions of people that are trading all around the world at every point of the day. There's like $6 trillion that goes through the market. Like $6.9 trillion every single day. It's crazy. That's a number we cannot imagine. There are billions of people on the planet. There are hundreds of millions of traders, right? So people are hopping in every day. So brokers put us all together, right? But a bank, they're their own broker. They don't need a broker to hop into the market. They can just hop in. But what is 1%? It's a lot easier to get, maybe for us, 500,000, 600,000, maybe even $1 million just into the market. Probably not that much, but clumping them together with tens of thousands, hundreds of thousands of dollars. If these guys actually have as 1%, say they've got a division of Forex, because that's what they're going to have, like their own little company, like everyone's got HR, and they've got finance and this one, they've got marketing in this part of the company, this, banks will have a Forex department. So let's just say 1% really easily is $10 million. $10 million. Let's just say that for the sake of the argument, right? Can they put $10 million straight into the market? Absolutely not. There are such things as too big of an order, because we're always competing. There's only so much liquidity in the market. And if they did do this, well, it would be market manipulation. If we just put $10 million in for this example, what would probably happen to the market if it was a sell? It would just fall off the face of the earth. Now, for multiple reasons, that is not viable. Not viable. It's not allowed. They're going to get fined for that, because countries need their currencies to be relatively stable. If it's just flying up and down and banks can hop in for a $10 million sell here and $10 million buy here, $100 million sell there, well, what happens when they're trading with other countries? They're saying, oh, okay, we want to buy $100,000 of your wool. And then all of a sudden when they go to buy it, that $100,000 was incredibly devalued. So they only get half of the products they originally thought they could buy, right? They look at it and they go, oh, where's all the rest of our wool that we want to buy? Well, your currency at the time that you bought it was incredibly devalued. It actually fell off. If European countries are trading with Canadian countries and they're trying to do that, they're trying to buy it off the Canadians, well, what's going to happen there? And what happens if the Canadian dollar just suddenly falls off the face of the earth? Or the European dollar goes hugely up? Then they've bought all this wool for a tiny amount. And the Canadians going, hey, you haven't paid us enough. And they go, actually, our euro just shot up to the moon just right now. So yes, we've only paid for all of this wool with €1. Right? You can't do that. Obviously, these are ridiculous examples, but you start to get the picture of why this all has to be regulated. So with this all being regulated, and with them wanting to still trade with 1% of their account, the question is, how do they get as much money into the market as humanly possible? And I wish I had some sort of special effect for this. Probably could, but I am not a video editor. I would put this in a highlight. I would just go like I'd put a montage music around it and just go, oh my God, it's consolidation. That's what I would be looking at here, because that's what it is. That's how they get their 1% in, or as close to it as humanly possible, through consolidation. Because what happens when the market is moving in a sideways manner? Well, as I said, 90% of people do not understand what they should be doing when the market is moving sideways. Do you go in for a buy, or do you go in for a sell here? If I looked at over here, especially where it's faking out up here, would you be going in for buys or would you be going for sells? All of them would be pretty crap. basically all through here, atrocious. Atrocious. Nothing's good. However, when the market is obviously moving and it's trending, well, then you know that you should be going for buys, more or less, because the market's going up. When it's actually going down, hey, you should probably be going in for sells because the market's going down. A lot easier to say, hey, buys or sells. Even to a child here, they could probably go, well, the market looks like it's going up, so I'm probably going for buys. Oh, the market looks like it's going down, I'd probably be going for sells. But as traders, when it moves sideways, we're not taught what to do. But banks do know what to do. They've been doing this for years. Since I started roughly 8 years ago, it has not changed. That's why this strategy is so powerful, because you can still use it now as you can use it 8 years ago. My new updated strategies, I've had to change. They are slightly complex in their ways, so they need to be adaptable. This one doesn't. This one is as true as today as it was back then. Because what these guys like to do, what they love to do, is put order blocks into the markets. Now, if I just move this out of the way, you don't really need to know what an order block is. I'll go over it really quickly. But an order block is two things. It is a block of orders and it blocks the market from moving. So at some point, maybe over here, they would have put in a big sell somewhere around here, right? Maybe it was actually slightly higher and it was actually up at the very top. They pushed the sell in, so the market comes down. And that's what they did. Maybe it's $10,000, $20,000, $100,000, $200,000, something that's easy to put in the market, but they can put multiple of them. Again, blocks of orders. It might not just be one, it might be another one here and another one here to keep on pushing that market down. Maybe another one over here. Who knows, right? But it will start from somewhere over here, right? And it'll be a large block of orders. The dollar amount, I don't know, but enough to push the market down. And then they will put another block of orders down here for buys. Now, why would they do this? Because they're just pushing the market up and down and up and down and up and down. Their stop losses will be somewhere over here or over here. They have so much money that a stop loss is basically non-existent to smart money. They can be in drawdown for months, for years if they need to, because they know eventually they can push the market back. They've got so much money, and the government will bail them out anyway, that they don't really need to worry about it. So they'll put their stop losses up here and just make it that they're just staying relatively so in profits, no matter which way you look at it. If they're entering the market somewhere around here and here, and they keep it somewhere in here, a buy for here and a sell for here, they're just going to say somewhere in profits. That's great for them, but what about for us? What about for traders like us? Well, maybe we're support traders and we hop in because we see a triple bottom, or we're resistance traders and we hop in because maybe we see like a triple top in here. Maybe we're breakout traders and we thought, hey, we should hop in for a buy up here, or maybe some breakouts down here. Because what you can see is happening with these order blocks is it's forming support and resistance lines. Support and resistance lines. That's what it's doing. It's forming its own support and resistance. So what I would like you to do is basically, and we'll get into more of this in the next one, is imagine all these people hopping in. Again, millions of traders, hundreds of millions of traders, right? All hopping in at multiple points of the day. People who are support traders, resistance traders, order block traders, smart money concept traders. There's so many strategies that are in there, and all the hundreds of thousands of individual strategies that are saying, hey, buy or sell in this area. They're all hopping in. What does that do? That is increasing. That is increasing the amount of orders, the volatility, the liquidity, I should say, of what is happening in here. It just creates this liquidity pool. And we ask the question, how do banks get their 1% in? What if we create an artificial liquidity pool that's growing in orders and more orders, all these smaller ones, all these friends hopping in together, all these little businesses and bigger retail traders, right? We're all hopping in over the hours that this happened. Let's start at 2300. There's 24 hours. There's 48 hours. And it will go on and on and on. 48 hours for people to just put their orders in. And the hideous beauty of this is, again, if you're going in for buys or you're going in for sells, you're hopping in here and the market's realistically not moving up or down that much, it traps people into thinking, oh, well, it's actually not moving that far or that close towards my stop loss. If you're smart, you're always going to put it underneath here or up here, right? You're smart. That just makes sense, right? If you see it always hitting here, why would you put a stop loss here or here? I mean, you'd have to be particularly dumb. If you actually know what you're doing, and most traders, even if they're just beginning, can see, oh, well, I'll put it at the highest point or the lowest point, maybe give it a few pips. That makes sense, right? You're getting all these people hopping into the market, and suddenly over 48 hours, you might have $1 million. You might have $3 million in terms of online, at that moment, open trades. So what happens if I fast forward this and I do something like this and I fake it out? I've just taken all of these buyers out of the market. All of these buyers out of the market. How many hundreds, thousands, tens of thousands, hundreds of thousands, or maybe $1 million, millions of dollars is in there over 48 hours? And what happens when they just put in another sell order just big enough to push that market down, to force it down? Well, it's going to take all those people out. But you might be saying, Alex, there's an order block here. Why isn't this stopping it? Well, they're going to be in profits. So if they just want to put another sell in and this is blocking them for hopping into the market, why don't I just delete it? Why don't I just delete it? I'm a bank. I can do that. I'm in profits up here anyway. If I'm going for buys and I've got a buy and it's an order block underneath here, well, I can just get rid of it. I can just take my orders out of the market. I can just close them in tiny profits. What's stopping the market from going down now? Absolutely nothing. So they take all those people out. They push the market down and they put in orders of their own. Sells, buys, who knows? In a fake out, if I want to get more money into the market and really mess with everyone, a lot of people are going to go, oh my God, it's going to the downside. All the sellers might double their positions. They might put more money in. The buyers that are just lost, they could have FOMO. They could have revenge trading. There's so much stuff that could say, oh, I was wrong about the buys. I can clearly see the support now. I'm going to hop in for a sell. What happens? Oh, we come back. And then, apologies, I'm still trading at this time. Then we can see that the market actually moves down. And there is a massive move. And that is what we are looking to hop into. Out of consolidation zones, we usually see big moves. It's all about not getting faked out, because that's what we want to avoid. And that's what my strategy preys on. It preys on the fact that they want to put their 1% in, that retail traders are quite stupid. They are going to hop in. Smart money's going to take advantage of that. And when they do take advantage of it, we want to be there. We are hopping into the most dangerous waters that the market can possibly throw at us, because the reward is so high, because it is so large. And when this happens, we're going to hop in. We're going to have some really, really good trades. And it's all because of this stuff here. Everything. That is the concept behind it. That's what we're hopping into. That should get you excited, because I know it gets me excited. Now, in the next episode, I am going to be going over our entry rules. And then we're going to be going over take profits and stop losses. And then we'll be going on to even more stuff to make sure that you get this. But hopefully this is really eye-opening for you, that you're seeing something that's incredibly different. Of course, this is the internet. So if you disagree with me, write a comment. If you agree with me, write a comment. If you've got a question, put a comment in there. I don't mind. As long as you're nice, as long as you're not just slamming me, that's absolutely okay. Disagree with me if you will, but I'm the professional trader, so really up to you. You can have a good go at it. Anyway, that's it for this lesson, guys. I hope you've really enjoyed it, and I will see you in the next one. Bye.